All right, good morning, everyone. We're going to go ahead and get started. I am pleased to be with you this morning on this webinar. As you know, our fund is closing in a couple of days and wanted to make sure that we had an opportunity to answer questions about the current fund and give you a sneak peek of what's to come for the company as well. Before we get going, I'd like to do a few introductions. I have a number of AHP servicing and AHP employees with me today in the room. Some of those names may be new to you and some will be familiar. So I have Jeremiah here with us today. Jeremiah joined us recently as our Vice President of Accounting and Finance. He joins us most recently from Op Loans, which is a consumer lending company that also has a social mission behind it. So pleased to introduce all of you to Jeremiah.
Hello.
And then we also have Marilyn O'Shea with us today. Marilyn recently joined us as a Vice President and the Chief Resolution Officer of the company. So we'll talk later this morning about getting ready to move our servicing in-house, and obviously given our social mission and our focus on investing in non-performing loans, the resolution team is a key team that we're building out. Marilyn was previously the Vice President of Loss Mitigation for Wintrust Mortgage. She spent 15 years at Wintrust Mortgage. I had the pleasure of working with her for about 4 of those years. And in addition to a background in loss mitigation, she also has a very strong background in quality control, research, and legal. So, and that's just kind of touching on a number of the things that she's done in the past. So she's a great addition to our team. So welcome, Marilyn.
Good morning.
We also have Mike here in Investor Relations, who probably needs no introduction to most of the investors that we have on the line. So welcome, Mike.
Hi, everyone.
And last but never least, we have Saeed with us today. Saeed heads up our technology initiatives, including web development, and keeps us all wired. So he's here to handle our webinar for us today.
Hi, everyone.
So with that, let's go ahead and get going. I guess I should also give you a little background on me. I joined in March as the President and CEO, taking over the reins from George Newberry, who I know many of you have a long and positive relationship with, and looking forward to continuing the work that he has started. So thank you. Let's go ahead and flip. All right, so AHP, I know we've got a number of people here who have already invested in the fund, in addition to having a number of people who are considering making an investment before the current fund closes. So a couple of the things that really set AHP apart, we're open to both accredited and non-accredited investors. Low minimum entry of $100. Excuse me. We also have recently posted our 2017 audit results, so if you haven't had a chance to check those out, they are posted on the fund. So please go ahead and check that out. In terms of the returns on investments, so there's a priority 12% return to investors before the company takes any profit for itself. And then kind of next in the waterfall is a return of principal for our investors. So we'll talk a little bit about what happens with all of those things when the fund closes a little bit later in the presentation. But the short answer is you'll continue to receive that 12% priority return, and then you know, we'll continue to invest those dollars, and the funds will be returned to the investors. The goal is within 5 years of you making that investment. Of course, the underpinning for our company is the social impact mission that we have, and that social mission is, you know, helping to keep struggling homeowners in their homes whenever possible, and we do that by offering them no doc modifications to reduce their principal payments, as well as offering them reduced payoffs of the principal balance on their loans. So you'll also see up there on the screen, if you're following along, liquidity. So we have best efforts liquidity. We do our best to process redemption requests within 30 days. Of course, that's not guaranteed. Historically, that's not been a problem, and we've been able to meet all of the liquidity requests for the funds. Quick summary there for you on how it works. It is a very quick online registration process. As part of my due diligence when I was talking with George about coming in as the CEO, I made an investment online to see how the process works. And my personal opinion is that it is as quick and easy as any online investment that you're going to make right now. So it only takes a few minutes, works very well. And of course, Mike and Investor Relations and our other team members are always available if you have any questions through that process. So quick overview of the current fund for you. We have now made investments in all 50 states, so we are truly a nationwide buyer of non-performing mortgages. We continue to focus on low balance and issue loans. So oftentimes the loans that we're purchasing have been through a number of hands before they get to us. And, you know, it's one of the other things that I was looking at as I was doing due diligence on AHP and understanding their mission and the opportunity was getting a sense for what does that market look like right now. We're about 10 years past the financial crisis, and so one of the questions I had is how big is that market in the present economic environment. And so we've got some stats to share with you there. You'll see that approximately 9% of homeowners across the country are still considered to be seriously underwater. And in 2017, there were about 676,000 new foreclosures. So we continue to see a pretty strong flow of deals that we're looking at. There is some competition in the market, but we just closed on a new investment last week, and we're looking at several this week as well. So that deal flow continues to be fairly strong. And you'll see there we have a snapshot of where we were at year-end 12/31/17. We'd acquired about 2,500 loans, outstanding principal balance of about $138 million. And our average purchase price versus the outstanding principal was about 18%. So let's get to the questions that we're getting most often, which is what happens after the fund closes? So you keep earning a distribution. That distribution will not change. Again, goal is 12% priority return. Where you will see a change is that if you were making automatic monthly contributions, those will end when the fund closes because we're not taking in any new money. We're continuing to invest and put the money to work that we've acquired and that has been invested so far. So per the terms of our operating agreement, we will use our best efforts to return your capital by the 5th anniversary following your investment in the fund. Historically, they have been able to return those investments in less than 5 years, and as we mentioned previously, the best efforts liquidity is not affected by the fund closing. So other things I'd just like to highlight, since we've had a large inflow of investments in the last month or so, if for any reason you need to redeem your shares early, there is a slight reduction to your return. So if you need to redeem within the first 6 months, your return will be reduced to a 10% annualized, and in that next 6-month period, it will be reduced to 11%, still obviously substantially higher than money markets and comparable alternatives. So here, as I mentioned earlier, we have now invested in all 50 states. That's an update from the last time we presented. I think we were at 49 states for an extended period of time. We're now all 50 states plus Puerto Rico, so it's truly a national portfolio. And what we have found is, you know, the recovery, especially in the low to moderate income neighborhoods, has been a little bit uneven across the nation. So we continue to find opportunities to help homeowners. So the new fund, we've had a lot of questions about the new fund, and we appreciate everyone's interest and the anticipation with the new fund. So to give you a little color there, we anticipate submitting the initial draft of our offering memorandum in the coming weeks, and we're actively working on that right now. Once the SEC qualifies that investment, we will launch the new fund, and we anticipate that will happen sometime in the fall of 2018. The new fund will go out under AHP servicing rather than being a new A+ fund, and we will, somewhat simultaneous with launching that new fund, be bringing our servicing in-house. So I know many of you have heard about this from the Note Buyer Bootcamp. We've got some information posted on our website, and George has had conversations with a number of you, as have I. Over the years, what AHP has learned is that there's really not a servicer out there who specializes in this segment of the market that really has provided outstanding service. And so we feel that we can do a better job ourselves working with homeowners and working efficiently than we can with a third-party servicer. Initially, I think it may be a little bit more expensive for us to service in-house. Over time, once we're up and running and we've completed our pilot, I think we're going to find that we gain efficiency, and it becomes probably the more cost-effective option, as well as the better option for homeowners and the better kind of service option. So the new fund will go out under AHP servicing. We are looking at changing the preferred return to investors for the new fund to 10% from 12%. We have had a few questions on why we've made that change. And so if we move on to the next slide, we've got some information there for that. And so really what we did is we took a look at comparable investments in the crowdfunded space and in the real estate space to see what returns were out there in the market. We looked at our history of returns, and we really feel that 10% is still kind of the top of the market in terms of alternative investments. So that's where we're leaning right now. Obviously, when the next fund comes out, you'll see the final numbers there, and if market conditions change between now and then, we'll certainly evaluate that. But right now, we think that 10% is the right hurdle rate for us. In terms of when we're going to start servicing loans for ourselves and for others, we anticipate that by the third or fourth quarter, we'll be running a pilot of our loans. Once we're through that pilot and we've done a kind of final look at regulatory compliance and other things that we feel very strongly about for the portfolio, we'll start moving our loans from third-party servicers in-house. And we anticipate that by January 1st, at the latest, we will open the doors to servicing for third parties. If we are ready to service for third parties earlier, we'll certainly open the gates. We've had a lot of interest in that, but we do want to make sure that we really have all of the plumbing in place and tested before we do that. Got a few little blurbs up there for the media, so if you haven't checked us out, please feel free to do that. I'm not going to review those for the group. And finally, we've got a snapshot of some of the key figures for the fund at year end, over 1,100 investors. So thank you to all of you for your interest in the fund and for your belief in the social mission that backs the foundation and the mission we continue to live by. Purchased, as I mentioned earlier, about 2,500 mortgages this year. As of year end, we continue to do that this year. And have been fairly active on the buy and the sell side, and have raised just under 17 million as of year end. So at this point in the year, over 17 million raised. And with that, we are going to open it up for questions. You'll see our last page there is the standard disclosure that we have on forward-looking statements. So if you do have questions, please feel free to write those questions down in the box on your webinar screen. We're going to give folks a minute to see if they have any questions. And if not, I'll take that as a win and assume that I answered every burning question that you have today. All right, we're going to start with Jackie. So Jackie has a question about how much expertise we have and what kind of hiring we're going to do to start servicing our loans in-house, and how will it affect fund performance. So in terms of the expertise that we have in-house, prior to joining AHP Fund, I was with Wintrust. I actually established and centralized their residential loan servicing portfolio. I also established their default loan servicing portfolio, and that is over $1 billion portfolio. So I myself have a lot of expertise, which is one of the reasons that we thought it was a great fit. We've also hired a senior vice president of servicing who starts on June 4th. I'm not going to announce his name because he hasn't joined us yet. And then we have a number of folks currently working with us who come from competitors. And so they'll be involved in working on the servicing side of the house as well. And then in addition to that, we're in the process of implementing our core servicing platform and are working very closely with a third-party consultant that we have a great relationship with, who has implemented the same system for several other companies. In addition to that, we recently hired a chief compliance officer, again from one of our competitors, and he's overseeing licensure and a number of related areas for the infrastructure of the company. So we feel that we've got a really great team in place, and as we bring those funds in, those loans in, excuse me, we'll be proactively hiring and training to make sure that we've got staff coming in a couple weeks or 30 days before the loans come in, so that they're fully up to speed on our systems. In terms of how it affects fund performance, really too early for me to speculate on that. But as I mentioned earlier, long term, we think it's going to be better for the fund and better for our borrowers as well. Oh, no. So next question from Roxanne, can you discuss a bit how IRA accounts will be handled? So there'll be no change in terms of how IRA accounts are handled. So it'll go through the same process that we've used historically. So Roxanne, I would say if you have a specific question for your account, I would encourage you to reach out to Mike after this call, and you can reach him at invest@ahpfund.com. So Katrina's question, I normally reinvest my dividends. Can I continue to do that? And the answer to that is no, because we're not taking any additional investments in the fund. A reinvestment is considered an investment, and so the reinvestments will stop and you will start receiving cash dividends. Next question is from Paul. Is there any discussion around having an additional return based on performance of the fund? And the answer to that is no. I'm intrigued by that question, but we have not had any conversations around that. Next question is from Marcia, and I hope I'm pronouncing your name correctly. Apologies if I've messed it up there. So her question is, what does it mean that you will do your own loans? How does that work? So servicing is, if you've ever held a mortgage loan yourself, if you've ever taken out a loan on a house, for example, your loan is serviced by a company. And the company that services your loan is the company that sends you your periodic mortgage statements on a monthly basis. If you're escrowed for insurance and taxes, they're the ones who pay your insurance and taxes. And they're also the ones who do an annual review of your escrow. If you have questions on your loan, that's the company that you contact. And so all of those things for us will be moving in-house so that we'll have that direct borrower contact. We think it's going to provide a much higher level of customer service. And because the majority of the loans that we buy are non-performing, our borrower outreach for offering modifications, discounted payoff, deed in lieu of foreclosure, cash for keys, all of those things will be done by our employees once we've moved the servicing in-house. And we do think that we'll have better outcomes, and we'll also be closer to our borrowers, right? So we want to be close to our investors because we have a responsibility to invest your money wisely, and we want to be close to our borrowers because we do have that social mission, and we want to make sure that we're providing the best outcomes possible. All right, really interesting question up next from Amir, and again, I hope I pronounced your name correctly. Will the new fund invest in both servicing and new loan purchases? So right now, we intend to invest in new loan purchases. We don't have any plans currently to invest strictly in mortgage servicing rights, which I think is your question. However, we will be opening servicing to third parties, so we will be servicing for others as well as for ourselves. So the next question is from Helen, and she's asking about how early redemptions work. So as we mentioned previously, it's best efforts liquidity, and we look at available cash flow, and if we can make that redemption for you, we do. We try to do that within 30 days. In terms of the reductions, so as I mentioned previously, during that first 6 months after you make your individual investment, if you're redeeming within that 6-month period, your annualized return is reduced to 10%. If you're redeeming within that next 6 months period, so let's call it 6 to 12 months after you make your personal investment, then it's reduced to 11%. All right, so the next question is from Arthur, and he is asking, is the 5-year return from the date we invested or the date the fund was created? So great question. Arthur, the 5-year payback period is from the date that you invested in the fund versus the creation date of the fund. So the next question is about the average mortgage size of $10,000. Are you cost effectively able to service these, especially in-house? So whether we're servicing with a third party or we're servicing in-house, I think our costs are going to be comparable. So I don't think that's an issue in terms of return. You are correct that with the smaller mortgage balances, and in particular balances under 10,000, there's a little bit less wiggle room. But we don't have a lot of balances that are under $10,000, so I don't see that being a material piece of the puzzle. And oftentimes we find that with those lower balance loans, there are more opportunities to settle the loans. So one of the things that we offer is a discounted payoff. So if we're acquiring a loan with a very small balance, it's often much easier for that borrower to either refinance the loan or to go to friends and family and create that liquidity to settle the loan. All right. Next question is from Judy, and she is asking, where did George go? So George, two questions for that. One, right now, George is on vacation this week, that's why he's not here with us today. George does remain a principal investor in the company, and he is also the chairman of the board. So he will not be involved in the day-to-day, but I can assure you that he has an abiding interest in the company and our success. All right, next question is from Stephen, which I may have answered in the interim period, but just to make sure he gets his answer. When the fund closes, can we keep reinvesting the returns, or do they need to be paid out? So those will need to be paid out as dividend. Once the fund closes, we cannot accept reinvestments. Next question is from a different Stephen. And so Stephen is asking, can additional funds be added through the 24th of this month? And the answer is absolutely they can. And so to provide a little more color on that, you need to get your paperwork in by the 24th, and then the funds can follow shortly thereafter. We do have a little bit of wiggle room. We're trying to wrap that up as promptly as possible, but we do understand with investments like IRAs, for example, there can be a little bit of a lag time between sending in the paperwork and the funds transferring in. Next question is from Brian. Can you talk about liquidity in the new fund? Will it be the same as the current fund? So I cannot answer that question yet. What I can tell you is on a more global basis, we anticipate that there will be a slight reduction in the return for folks who need to redeem early, but we have not finalized those figures. Once they do, and we're closer to launching the new fund, we'll have a new webinar, and happy to go through those details at that time. Hi, so the next question is from Andrew. Is Thursday 5 p.m. the cutoff for the current fund investment? And the answer to that question is yes. So please try to get your additional investments in by the end of the day on Thursday. So next question is from Gary. Why was the fund closed before the $50 million investment threshold was reached? And that's because under the SEC regulations, we're allowed to keep the fund open for 2 years. And so during that 2-year period, we can accept as much as people want to invest up to the cap of 50 million, but the kind of gating issue is sort of an either or, the earlier to occur. And so for this particular fund, earlier to occur was 2 years. Next question is from Glenn. Will the new fund have a termination date when it is closed to new investors as well? And the answer to that is yes. We'll have that same 2-year period to accept investments. All right, so the next question on the board that we haven't already answered is from Paul. Will the fund, hold on, somebody's moving the question.
Okay.
Will the next fund provisions be similar to the current fund, liquidity, et cetera, only difference being the return? They will be similar, but not identical. So at the moment, we're going through and looking at the last fund and seeing whether we need to make any other updates or changes. So there'll likely be a little bit of an evolution, but we're not anticipating any dramatic changes. So next question is from Richard. I think we answered this, but just to be on the safe side, the question is, if I create a new IRA investment account, but the funds are not received before May 24th, what happens? And so we do have a period of time, and we do understand that with IRA investments, it does take a little bit of time. So we'll be able to keep those investments coming in as long as your paperwork is in by the end of the day on the 24th. And our goal would be over the next 2-week period following the 24th that we get all of those investments and dollars in the door so we can start investing your funds for you. Next question is from Randall. Please explain what will happen with the distributions after the fund closes regarding IRAs. So the monthly distributions will be handled in exactly the same way that they were handled previously. So Randall, one other item I want to clarify, Mike had a good point, is that those monthly distributions will be paid to your custodian. And then the next question up is from Paul. Will mortgage rates rising be beneficial or a hindrance to AHP? Or is it somewhat irrelevant? And so, Paul, that's a great question. I think interest rates are one of the factors that affect the overall market. The overall economy is just as important because it's probably a bigger factor in terms of whether borrowers are able to make their monthly payments. So I would say the short answer is I don't think we're going to see much change over the next year. Where we're going to see the bigger change, we're somewhat counter-cyclical. So when we're in an environment with rising defaults, we have more opportunity to purchase non-performing loans and help reposition those for borrowers. But right now we still have a steady flow. So I don't think over the next year we're going to see a big change. Edward, next question. Will there be a separate investment opportunity into AHP servicing? So because the new fund is going to be launched under AHP servicing, we're kind of combining those two segments of the business, together under one fund. So that's kind of where you're going to see that revenue growth. And I think certainly it'll be good for the company because we'll have the profits from working out the funds and the profits from the servicing business, which I think will just kind of help make the company stronger. Okay, so the next question on the board that we haven't answered comes from Bob. Do you expect the next fund to cover a 5-year investment period like the current fund? Yes, I do. So the next question is, again, a pretty forward-looking statement that is going to be impacted by the larger U.S. economy, and this question comes from Praveen. Will your general strategy business model change if we enter another real estate down market similar to what happened in 2007, 2008? And so, as I mentioned earlier, because we're counter-cyclical, if we enter another real estate correction, I think that's going to be good for the business, because we'll have more opportunities in the market to purchase, and because we have a large level of sophistication in this space, I think we'll be able to take advantage of some of that market disruption when the next cycle happens. At a broader level, depending on where we are as a company, we may look at making a small number of investments for commercial non-performing loans. That's an area that I and a number of other people in the company have some significant expertise on. So I don't think that's going to fundamentally change our business model, but it may present itself as an opportunity to look at a little bit of a diversification. But the majority of our investments, I anticipate, will still be in residential non-performing loans. So the next question comes from Glenn. Can I invest my HSA fund? How does that work when paying medical expenses incurred? And so we're going to have Mike answer that question for you.
Hi, Glenn. Yes, so you can definitely invest with HSA funds. Generally, that's an account opened up through a custodian. Usually, any payments for medical bills are then handled through them also. So that's something you would need to coordinate with your custodian along with us, okay?
Okay, so we're going to take another 2 or 3 questions here, and then we'll wrap up. Next question is from Roxanne. Is there an accelerated timeline for return of capital after the fund closes? The answer to that is no. So, we'll continue to manage the fund as we have in the past. As I mentioned earlier, with prior funds, they've been able to return their capital in general in less than 5 years. No guarantee that will be the case for this fund. But no reason to think we're going to have an extremely accelerated timeline either. All right, next question comes from Jerry. How will we be notified when the new fund is open, and can I assume it will be the same process to invest? So we will keep you informed on our website, on our progress. We also are taking investor information if you'd like to be put on the waiting list for the new fund or for information for the new fund. So if you'd like to do that, we're happy to take down your information. So you can shoot Mike an email at invest@ahpfund.com. And we'll certainly be hosting a webinar and other information before the new fund opens to give you all of the details and make sure everyone knows how to invest. In terms of the investment process, I anticipate it will be substantially the same, and we'll continue to use technology to make it as easy as possible for you to invest. Okay, so next question comes from CIP, I think are the initials that are on the board. Will the dividends be automatically reinvested when opted in the new fund coming this fall? The answer to that question is yes. All right, so we're going to take 2 more questions today, and then we're going to wrap up. So if I don't get to a specific question that you had, again, please reach out to us. You can reach us at invest@ahpfund.com, and we're happy to take any additional questions. So the last two, second to last, is from Paul. Is the decision to lower the return to 10% based on lower margin expectations for AHP, or just that the return is higher than competitors out there? And it's because it's higher than competitors out there. So AHP celebrated its 10-year anniversary this month. And when the original funds were opened, it was kind of an untried business model and pretty new to market. The 12% return reflected that lack of history and the higher perceived risk. Having 10 years under our belt of strong returns, and we feel that we're not a higher risk profile any longer than the other competitors out there. And the competitors that we surveyed are generally offering somewhere between 7 and 9%. So we felt 10% still gives us a double-digit return, which, let's be honest, in the interest rate environment for the last decade, I think we're all looking for. So we think it's a very competitive investment return, but it's more reflective of the fact that we've, grown up a little bit over the years, if you will. Okay, so last question, are insiders co-invested in the fund? The answer to that question is yes. Our principal owners, there are 3 principal owners, all 3 of them are invested in the fund, and in fact, several of those investors have just invested more in the current fund. So along with you, trying to get in before the investment period closes. So with that, we're going to close it down. Thank you so much for your participation. We had a great turnout today. I hope I was able to answer most of your questions, and we look forward to answering any additional questions, to taking your investments over the next couple of days, and to keeping you informed on progress to launching the next fund. Thank you so much for your support.